Hello and welcome to another special edition of the podcast. Today we're delighted to be joined by Emily Whiting, Emerging Markets and Asia Pacific Investment Specialist at JPMorgan. Hi Emily, thanks for joining the podcast.
Hi, how are you? How are you?
Very well, thanks. Now today we're going to focus on investment trust JPMorgan Asia Growth and Income. So it's focusing on total return from investing in Asian equities but excluding Japan. What would you say sets the trust apart from others in the sector, Emily?
Excellent. Well, look, first of all, thank you for having us and spotlighting this trust. What I think really works that differentiates us is the manner in which the income is generated. So I think when you look across the peer group, a lot of the trusts generate natural dividends, as I would term it. But what we do with JAGI is allow one of the great mechanisms of the closed-end structure to generate a reliable income stream. So the board is looking to deliver an enhanced yield of 6% per annum, so 1.5%. Based on the NAV at the end of each quarter. And that doesn't therefore constrain the portfolio managers to only be looking for dividends. It means that they have the ability to look across the breadth of Asia at the best businesses, knowing that on top of whatever we generate from a growth standpoint, the vehicle can allow us to deliver this sustainable and reliable income stream as well.
Right, now that's really helpful. How important a role does the specialist EMAP team at JPMorgan play in kind of helping the managers pick the best opportunities?
Hugely. It's all about active management, is our view. And I think, to be honest, that you've got such a geographically diverse region in Asia, numerous different languages and cultures and so on. People on the ground, in many cases native to those markets, really are invaluable. I think when you're looking at active management and investing, it's all about almost looking at the odds and ensuring that the odds are in your direction. And therefore, the more insight and the more information you have and you can harness as you come to your decision making, the greater chance you have of delivering. And I think that's something that we've shown that we can pull all of that together in the framework of JAGI by way of using these insights of our team on the ground in Shanghai and Seoul and Taipei and Hong Kong, who feed these ideas into the portfolio managers to decide how they're going to construct that portfolio. So I would argue that the people aspect is fundamental to how we look to set out investing across Asia.
It's interesting actually, because it begs the question, I suppose, that culture is quite an important factor. Asian culture is of course very different to what we're used to on the Occidental side of the world. Just so having sort of local knowledge on the ground, that in itself must be a big asset.
Oh, massively. I mean, when you think about how different cultures are across Asia, that you've got China with its famous or rather infamous one-child policy. Clearly, sure. What works there, given that they don't have as big a family set up as somewhere like some of the ASEAN markets where 3 or 4 children are far more common, then that makes a huge differentiation by way of what could work and what doesn't. And I think you hit upon a really interesting point, that the easiest way to think about it is a good story doesn't always make a good investment. So just because something sounds theoretically like that's a great business, the beauty of Asia, but also the pothole, you could argue, if you don't understand the region, is you can't just lift and drop what works in one market to what works in another. So yeah, I would agree. I think the cultural aspect, the business cycle aspect, and where a market is in its business cycle, its economic backdrop, all of which creates this hugely diverse region that you need to be able to be plugged into all of those components in order to find those best decisions.
Yeah, I'm curious as well in terms of sort of how the valuation landscape is. I mean, a lot of our retail investors will be much more familiar with Japan, but you're ex-Japan. So it's much more about the emerging market side of the story. So just in terms of comparisons, how do companies generally valuations roughly compare to, say, US, European companies?
Well, I'm going to give you what's actually a really annoying answer, in that it depends. And the reason it depends is, as we've said, it's a hugely diverse region. Sure. I think you could argue that in a number of areas, valuations look maybe a tad richer than they did a year or two ago because technology has done so well. So when you think about Asia, Taiwan leads on semiconductors, Korea leads on memory, those prices have been elevated. They still importantly look cheap versus developed market peers. So if I was to compare Taiwanese and Korean tech with US tech, it still looks 25–30% cheaper. Likewise, when I think about the other end of the valuation spectrum for emerging Asia, India has historically always been expensive. It's come down from its peaks because it's really struggled versus the rest of the region in the last year or so. But you would still argue it optically looks expensive versus other markets. So I think valuation in and of itself is often a really difficult measure, right? Because you want the context, you want something to balance it off again. What our view is going to be is, does it feel like the right price? Does it feel fair? Does it feel like the company and the valuation have got ahead of itself? In which case we maybe look to trim. Also, what's going on that maybe drives a re-rating? If you mentioned Japan, Korea has had a similar corporate governance revolution in the last few years, which means you've seen a bit of a re-rating of the market across the board. So people historically spoke about the Korea discount because things always look very cheap because of the family ownership structures and the fact there's all these cross shareholdings. That's all lifted. It still looks cheap, but it doesn't look as cheap as it used to relative to itself. So I would say that valuations right now are fair because we've had a good run. There's clearly been a pullback because of the Middle Eastern conflict that we've seen, but they're not at the eye-watering levels that we've maybe seen in markets like India historically.
Yeah, and you just mentioned the governance issue in South Korea particularly, and so it's worth just flagging that. Just wonder, I'm not an expert in this field. Is this still an ongoing process, or has it largely gone through the process?
And again, I think it's a super observation because it's created a lot of headlines. And I think the thing with these things is investors are very cynical, right? We've all been in the market several decades. We've heard about all of these false dawns before. And so with Korea, as I mentioned, there's always been this view that it's the Korea discount, it's always cheap, cross holdings and ownership structures and so what. So over the last 2 or 3 years, there's been a really concerted push from the regulator, the central bank, the stock exchange to encourage corporates in Korea to essentially give more back to minority investors, minority shareholders. Very similar to what's been happening in Japan, where you could argue they're further advanced and further down that road. With Korea, I would say it's still very much early stage. You've had the low-hanging fruit picked, right? The companies that really needed to turn themselves around and show intent have. We've seen more and more companies come out and speak publicly about having a dividend policy or buying back shares. All of these things that are additive to minority investors. But I think, as with everything, you need to see it time after time after time. So it's by no means a sort of one and done situation. It's still in the first couple of chapters. I think the big question is, will it continue? Because there's maybe still a lot of skepticism because of the market, because of the traits it's always had. But it's definitely been really beneficial for the market overall, and I think it's built up a nice momentum behind it.
Yeah, great.
Right. Yeah, and just talking about dividend policy, so the trust has this enhanced dividend policy, doesn't it? Can you just tell us a bit more about that? And does every stock in the portfolio have to pay a dividend at the point of purchase?
Absolutely. So the enhanced dividend policy is very much led by what we can do from a vehicle standpoint. So to answer your question, James, no, not every stock has to pay a dividend. In fact, we don't directly look for dividends. I think we would always view it that a dividend is a nice kicker to returns because it's a great proxy for corporate governance. But for this mandate, the dividend is not an objective for us. What we're doing with the enhanced yield is the board have, as the name suggests, enhanced it from 4% a year to 6% a year, paid out as 4 quarterly dividend payments of 1.5% of NAV based on the NAV at the end of the previous quarter. So what this is essentially attempting to do is say, look, we believe that we can go out and find growth and deliver returns in Asia, but we also recognize the importance of, firstly, maybe cushioning your returns, right? Because a dividend helps smooth some of the volatility you maybe get from your return coming out. And also it pays you to be patient and pays you to be invested. And so since this got rolled out in the last couple of years, I think we've seen very clearly that it's helped reduce the discount. I think it's been very positively received by retail investors in particular, who are looking to diversify their income streams. I think it's very fair to say UK investors traditionally have the majority of their dividend income and their income stream coming from the UK. This just gives them a really nice way to diversify it to a portion of the world where 4.5 billion people live, work and consume. And so it gives them that exposure, but in a more gentle or softer way.
Yeah. I mean, you mentioned previously Samsung and TSMC. It's such a big thing across the globe, the AI infrastructure cycle. I just wonder to what extent your managers are very much focusing on that. You mentioned TSMC, you mentioned Samsung, SK Hynix as well, another big tech stock there. Has that altered their planning, their processes?
I wouldn't say it's altered anything. I think, as with everything, when you're investing, you need to be somewhat pragmatic to where the opportunities are, and recognize that opportunities shift over time. So I think one of the things is you need to not be too stubborn with the areas that you look at. And I think we've clearly seen globally a huge evolution in technology in the last couple of years. And I think what often gets missed, but the point that you've very clearly made, is that a lot of this is born out of Asia. And so if you think about NVIDIA, which everyone's heard of in the US, if NVIDIA build a new data center, 40% of the spend that goes into that data center actually comes from companies in Asia, right? The cooling, the power, the semiconductors, and so on. And so Asia is very much the heart of technology. However, we want to ensure that this is very much a core investment approach, that we're not looking to just become a technology fund. So yes, we do have broader exposures. You mentioned some of the names. I'd also throw in, we have a Chinese company called Hongfa Technology, who are the #1 globally in relay switches that basically allow you to switch an electrical current on and off. We've got all chip technologies that are chip design. We've got one of these calling companies, WeWin, that I mentioned. But I would still argue that technology, albeit a material component within the trust, this isn't just about technology, because as I mentioned earlier, I think we've also got to be cautious of valuations, right? Some of these names have run up an awful lot. We want to just generate a consistent return investing in Asia, rather than looking to ultimately shoot the lights out because one of the tech companies absolutely flies but breaks our process. So I think discipline continues to be really important.
Yeah, and I guess, I mean, that's where retail investors get the value add of the active management team, is able to make those valuation calls, those judgment calls about what is expensive and what's realistic, you know, and so to push that kind of growth element of the trust, but at the same time in a disciplined way.
Yeah, absolutely. And I think that is where there's that really delicate balance. And therefore, you want to have as much information to consume to make that decision as you can. And as I said, we've got over 100 people sat within our emerging markets and Asia Pacific team. They speak over 20 languages. We go out and we kick the tires on, 3,000 companies a year. And I think those analysts, they really are our edge. So we have a autos analyst who sits out in Hong Kong. He covers a lot of the new or the Chinese EV companies. Right? Yeah. His first role prior to moving to JPMorgan was he worked for Chrysler when they first set up in China. So he's got real life experience of the auto industry in China, and he now covers the likes of BYD and Xiaomi. That's hugely powerful. As I said, all of these things don't sit together and mean that you always make the right decision, but they just enhance the ability to sift through all of that information and understand what really resonates and what's important.
Yeah, I mean, it sounds like it's one hell of a task. As you said, you kick the tires on 3,000 companies a year. I mean, that's nearly 10 a day. I mean, that's quite mind-boggling.
Yeah, well, that's where I think we've got the strength of the team, like one of the largest teams in the industry. So we have an awful lot of analysts, career analysts, so people who looked at companies maybe from pre-IPO all the way through to where they are now as multi-billion-dollar businesses. And having people on the ground, being a big name such as JPMorgan helps open the doors, right? One of the things that I think we're very fortunate to be able to always get is exposure to management, to really speak to the decision makers at the top, and to really understand the direction of business and whether it fits with the type of company we want. And as I said, I think what's always crucial is to just remember that a good story doesn't always make a good investment. And it's as important to understand the companies that you don't want to invest in as to understand where you do want to invest in. So yeah, I think the team and the technology that we have behind the team is hugely additive to allowing us to make these decisions and position ourselves.
That's really helpful, Emily. I mean, I think it's really it kind of brings us full circle now. It's just about that discipline and about that process. Thank you very much for your time. That's really interesting stuff. And listeners, thank you very much for tuning in. If you'd like to get more information, there's plenty of information on the JAGI website, and we have plenty more podcasts coming up down the line. So please keep tuned in, and we'll see you next time. Cheerio.